that caught me off guard. So I was working like almost two jobs basically from the engineering side and then, trying to grow my real estate portfolio. And then also coming to realize like it's going to take me like 50 houses to be able to make anything that I wanted real estate to do for me. So
Mm.
we, all right, I partnered up with this other guy. We started looking at Airbnbs because they cash flowed in a much higher return, which was a better opportunity for us to kind of grow. So from there.
Hi, everybody, and welcome back to Break Free from Wall Street, the show where we help investors build wealth outside of the stock market. I'm Nick Sahagan. I'm your host today. Today, we're digging into a question I think a lot of our listeners wrestle with. How do you own real estate and earn income from it without it becoming a second job or without it overtaking your life and what you already have going on? And I'm really excited for our guests to be able to help us answer that question today. His name is Keaton Thames. He's the founder of Honeyshares. And Keaton comes from an engineering background, but he's built Honeyshares to give investors direct ownership in professionally managed income producing properties. So super excited to have you on today, Keaton. Thank you so much for joining us today. And yeah, welcome to Break Free from Wall Street.
Thanks, Nick. Excited to be here, man.
Yeah, absolutely. So, yeah, just wanted to get into it and kind of learn about you initially. And like I mentioned, you come from an engineering background, and that's not the traditional, real estate or Wall Street path. Tell us a little bit more about you. How does an engineer end up building a real estate investment platform?
Yeah, absolutely. So for starters, like you said, I don't come from a real estate background whatsoever. Nobody in my family has owned real estate outside of a primary residence, probably ever. And so actually earlier on in my days, I was raised by a single mom of three kids, and we were not poor, but definitely on the lower end of things. And I think that that put a desire in my heart that I, wanted to break free out of that for my family. And so I remember when I wanted to like figure out what I wanted to be when I grew up, but come conversing with my mom, and she said, if you want to make a lot of money, go be an engineer. So that's what I did. I went and studied engineering, got a great job out of school, and was for the first time in my life had some actual money, but not knowing what to do with it. And so early on started investing in, the stock market because that's what they tell you, stocks and bonds and 401k. So I was doing that, but wasn't really fulfilling. And I felt like there was more to do. So I stumbled upon real estate and really wanted to go down like the Burr method. So buying, rehabbing,
Mm,
renovating it, and then and refinancing and repeat. So bought a couple of single family rentals, started building out my own personal portfolio of single family, and quickly came to realize number one, this is a lot more work than they make it sound. And so that caught me off guard. So I was working like almost two jobs basically from the engineering side and then, trying to grow my real estate portfolio. And then also coming to realize like it's going to take me like 50 houses to be able to make anything that I wanted real estate to do for me. So
mm.
we, all right, I partnered up with this other guy. We started looking at Airbnbs because they cash flowed in a much higher return, which was a better opportunity for us to kind of grow. So from there, started investing into Airbnb properties through a variety of strategies from Airbnb arbitrage to partnering and doing joint ventures with other real estate investors, and then to what we do today, which is raising private capital and then using those funds to invest using our team, and then investors participate in the benefits alongside us.
Yeah, absolutely. And just to touch back on your background a little bit, do you feel like since you didn't come from, the traditional mold of being brought up in real estate, do you feel like the engineering angle lets you look at it in a different way or, you know, I identify things that other people may have missed?
Yeah, I think so. Personally, I think engineers make great investors specifically because of our innate and analytical abilities, and just our tendency to look at things and want to understand things at every angle. So I've taken a lot of what I have leveraged from an analytics perspective and used that to strategize and formulate my own acquisitions criteria for evaluating real estate opportunities. because at the end of the day, it starts to become an equation. You know if a property is going to make sense before you move on it, and that's simply because of the due diligence piece. And then as far as operationally, so my engineering background was heavy into operations. That experience helps us to systemize some of our management teams, creating operating procedures and best practices so that we're always as efficient as we can be with our capital.
That's amazing. And with your platform, I feel like every platform says it's making real estate accessible. What was the specific problem you personally ran into that made you think, I need to build like if nobody's doing it right, do it yourself, right? So what at what point or I guess what specific problem did you run into that made you think like I need to do this myself and really cater it to the way I think it should be structured?
Yeah. I think for me personally, a lot of the people in my immediate circle saw what we were doing and wanted to participate in real estate, but didn't want to go get a second job or invest as much time as I had spent to build out their own portfolio. But they recognized that the opportunity is there. And then so for another's taking that first initial step is very, very difficult. That's always the hardest part is to go fund that first property. And when you're doing it by yourself, it's even more challenging. So for a lot of people that want to get into real estate, don't necessarily want to do it by themselves because of all the risk and the unknown. Like, how do I know that this property is gonna, do right? I think I'm, looking at the numbers right, but I don't know this market or what are the unforeseen things that might come up. We're giving investors an opportunity to partner with us to learn from us, learn our skills, learn our strategies, learn our tools, but to take kind of like a back seat so that they can get started within real estate and learn those things to, whether it's to continue to do the passive stuff or have the ability and the preparedness to go do it themselves. So that's our mission, what we're trying to solve. We think that everybody should be invested in real estate. It's the greatest wealth building opportunity of our lifetime. And so we're really trying to bring down the barriers to entry so that anybody could start regardless of where their starting point is.
I think that's great, and I totally agree. Beginners, especially, or people who are just coming into real estate, are faced with so many of these, hurdles and barriers of knowledge, of experience, and you don't know what you don't know. And having a fund or even a mentor, or just somebody who can give you some type of insight into that world, I think is by itself alone just incredibly valuable. And like you mentioned, I totally agree that real estate has some of the most upside among the alternative assets that are available, especially for self-directed IRAs. That's what we do as self safeguard advisors. So for somebody looking to get into that, and for listeners, especially in our audience who are tired of watching their 401k swing, back and forth with the stock market, can you help break down what owning a piece of real estate property actually gives them that a stock or an index fund itself just can't give them?
Yeah, absolutely. So I think you touched on a good point there is that when you are investing in a stock, there are a lot of factors that impact the value of that price that are outside of number one, that business's performance, just because of like speculation, but certainly outside of the investor's control. And so when you invest in real estate, there's a lot of things that you can do personally that influence the value of the position that you held. That's called forced appreciation. When you add value to a property or a business, then you are essentially forcing its value up. I think that that's one of the greatest things. And then also the tax incentives and the deferment opportunities investing in real estate that the stock markets just don't give you. So that tax deferred growth, or there's other tax strategies that you can use. All of that compounds over time. And once you understand the rate of compounding and what that magnitude does for you, it blows the stocks out of the water. I think that everybody should like. There's a place for stocks and there's a place for traditional 401ks and everything. But where I have found the most bang for my buck in real estate specifically is on the ability to take advantage of some of the tax incentives alongside some of our investments.
Yeah, absolutely. And to even take it a step further, taking advantage of the tax sheltered nature of retirement accounts in general. So if you are investing with a self-directed IRA, if you have a Roth self-directed IRA and you are, generating tax-free income and gains within your IRA, and that compounding, the math is just crazy. When you do break it down, when you do look at it, the returns that you can get when your money is making money and that money makes money and that money continues to make money, it's just this snowball effect that's really incredible when you break it down. I want to kind of get into the passive nature of what specifically you're doing, because I think a lot of people think real estate and passive is not something that immediately comes to your mind. You're like, oh man, I'm a landlord now and I'm a plumber and I'm this and I'm that. With investors investing in honey shares, what does passive really look like? What does that mean as far as day to day?
Yeah, absolutely. So our investors, and I want to touch on one thing really quick. So we take investors from all different aspects. Like some people invest with us through a business entity, some investors invest with us through cash that they have, and then some investors that are really, really excited, maybe don't know that the opportunities exist or that they have enough capital to invest in real estate. And that's when they'll take potentially an old 401k and roll it over to, like you said, an SDRA. And then they can use that and actually invest with old 401k funds that they thought were locked into real estate deals. So we have taken some investors like that. But basically, it's very, very simple. We source opportunities for investors. They send a wire transfer, and basically, they collect the returns from that. Our team handles everything from the acquisition to renovations to ongoing maintenance and management. There's no, 2 a.m. maintenance, toilet broke, get over here with your wrench
Right.
conversation. Our investors, yeah, they basically sit back, collect cash distributions. We pay out monthly, and then they get all of the same tax incentives and appreciation associated with that investment. So they're collecting and growing on more ways than.
Yeah, and speaking of returns, I believe the platform, when I was looking at the website, it looks like you're targeting returns around, 18% IRR and 12% annual cash flow. Those are really, really strong numbers. For some of our more sophisticated investors who maybe can look at those numbers and start to paint a picture in their mind, can you walk us through how you actually go about underwriting a deal to get to those types of returns?
Yeah, absolutely. So want to preface that every deal is different. Not
For
every
sure.
deal has the same strategy and returns that we're looking at. So the deal that you're referring to is actually a fund portfolio. So there's one of the big benefits of that is it's a diversified. We're essentially trying to lower the risk of being isolated into one single door. And our strategy, like I mentioned, we're big short-term rental, vacation rental investors. We've done, over 130 properties from different investment strategies, like I had talked about at the beginning of our conversation. So we know what we're doing. We basically go and um, implement premium amenities in our properties. Think like your luxury vacation rental stay that you would see. Those properties have very, very high cash flow, and so that cash flow is then a big driver in what is determining the returns on the investment. Like you had mentioned, the 12%, that's a target. Oftentimes, we try to do our best to blow it out. And one of the benefits of that fund specifically is the way that it's structured is our investors take a preferred position, which essentially is a fancy way of saying that they're going to get paid before we get paid.
Mm.
And we don't make any money unless the deal makes money. And I promise you this, we don't work for free. Uh, we're pretty good at what we're doing and creating those higher end opportunities that have high returns and cash flow. But to be honest with you, it didn't start like that. Like when we first started investing, we've made our fair share of mistakes. We invested in properties and got lucky a little bit with some of the really rapid appreciation that happened in 21 and 22. It kind of saved our butts, but all lessons learned, and we've taken all of those lessons and mistakes and bad purchases that we have had over the years, and we've used it to refine our playbook, to refine our model. So that way now, when we're raising funds and going to purchase, 10, 20, 30 different properties, the investors that partner with us get to leverage all of our experience and all of our lessons learned that we've already made along the way. So that's a big benefit to them.
For sure. Huge value add there. And you touched on something I think I want to break down maybe a little bit more for some of our beginner investors. You mentioned the position that the client or the investor would be in for any given fund. Can you talk a little bit more about what we're talking about there, positions on in the fund, or how that would be paid out?
Yeah, absolutely. In first position debt, that's essentially the lender that's providing debt on the property, or acquisition. In any form, a first position essentially is going to say that this bank is going to get paid first. Outside of that, and that's typically a smaller rate. So then our equity partners, the investors that come in, uh, when we offer a preferred return, that's essentially similar to debt. It's saying that the investor is going to get paid for this deal a minimum of 8% on their capital annually, before that there's any participation from the operating team. Now that 8% can be exceeded, and that's where we see that 12% target is being paid out annually. Does that answer your question?
Yeah, absolutely. Yeah, I wanted to break it down because I think, especially when you're just getting into real estate, it's really easy to get lost in any technical,
Yeah.
jargon of being in first position, second position, and yeah, just being able to break it down to some type of simple level, I feel like helps our listeners. And if they are sophisticated, maybe sometimes it's a great reminder. So yeah, I think that's perfect.
I will
Um,
say that it's not a second position debt because it's still equity. And so the difference between debt and equity, like if you have a debt investment, that's a
mhm,
fixed return. The benefit of having equity in the deal is you get the upside as well. And so our investors, we're giving them that preferred return. So it makes it a little bit safer, more incentivizing for our investors, but they also get to participate in the upside, meaning if the property does really, really well, or if the investment does really, really well, they're still going to be able to participate in all of those gains. Whereas if you invest on first or second position debt specifically, your gains are capped and they're pretty much locked in.
mm,
You're buying a return. So you can go lend your capital at, 8 or 10%. If that property does 40%, you still only get the 10% that you locked in at. So that's where the
mm.
equity position can be more valuable.
Interesting. Yeah, I think that's a really interesting insight that I wasn't even aware of. That's great. So, and you mentioned it's a safer route as far as risk is concerned, and I did want to talk about risk a little bit because I think a lot of people look at real estate as sometimes a more risky asset. But what are the real risks an investor takes with, especially this model of real estate investing? And I guess, what do you build into the fund to protect investors when a property underperforms or something like that?
Yeah, I think that's a really good question. And so I want to preface with saying that every investment has risk. There's no risk-free investment. If somebody tells you that, run. There's certainly risk, but we do what we can to mitigate the risk and then to acknowledge that they do exist and make sure that our investors are aware of them. So, number one, if you're going to go invest passively, make sure that you are confident in the operator's ability, that they have a proven track record, that they can execute on the things that they're saying that they can do, or that they have, a past of being able to do so. So that's number one. Number two, understanding what their risk mitigation strategies are. For us, we always have a reserve. So we typically, for every property that we're buying, we're holding 6 months of cash on the sidelines in case of something happens. And that's in addition to all of our insurance is that we carry on the properties.
So really just bring it back to risk. And a lot of our audience respects, you know, like you mentioned, that every investment has risk, but it's really important to understand, what the real risks are when you invest in a model like this, but also what protections have been built in to be able to protect investors, when a property may underperform or something like that. Can you tell us a little bit more about the risk that may be associated with these investments and what type of fail safes or structures you have in place to protect investors?
Absolutely. Yeah. So, like you mentioned, yes, every investment does have a risk, and it's important to understand what those risks are. For us, what we do as a group is every single opportunity or every single property that we're acquiring, we're holding 6 months of cash reserves that go to fund, the what if or the worst case scenarios, and so that capital is a safety net for us in addition to the insurance policies that we carry on each property. In addition to that, every property that we sign on, our team is securing and personally guaranteeing the debt, and so there's no debt liability or leverage against the investors personally because I'm signing on it. So that's another protection. As far as investors or as far as properties underperforming, because we're operating in a fund, we reserve the right to, and we're continuously evaluating performance. We can exit a property and then use that cash to reinvest it in something that is performing to or has the projections to perform at our caliber.
I think that's a really important thing for investors to understand. Like you said, nothing is going to be, risk free. There's no perfect world where you just make a buttload of money and there's no chance of anything going wrong. That just isn't reality. But I think, like you said, the protections that you have in place, making sure you have those cash reserves and being able to invest in other assets that are performing is a good hedge against something that may happen, like a deal underperforming or something like that. Um, when I was looking into to your company in general, I was noticing it is a relatively young company, um, and just as an investor looking into this, is it fair to judge a platform that is just building their track record, or are there certain advantages that you have as a newer platform when you're looking to get into something like this?
Yeah, absolutely. And yeah, while it is a newer company or a newer platform, our experience within real estate was the thesis behind why we started this entity. And so we've got a tremendous amount of experience within our operating team. We've launched over 130 short-term rental properties through different modes and mediums. We talked about that. We've got a property management business that manages and oversees 40 properties today. We're adding an additional 10 properties to that portfolio over the next 6 weeks because we do some third-party management as well within that business. And so all of that helps to, you know, cement our track record and our expertise. Now we're basically taking all of that experience and opening it up for the next level of scaling, which is what we're looking to do and open up and share our experiences. And so really, everybody starts somewhere. Amazon was 1 year old at one time,
Yeah.
Tesla, everything. So I think it's pretty cool that for the investors that are able to get in early and to watch us grow and to be able to participate alongside us. And then we are offering some pretty cool features today for, founding and early adopting investors that, I can't say for certain that those incentives will be around forever, but
Right.
for right now they're pretty cool. So there's some pluses for sure.
Absolutely. And you had mentioned earlier about, investors who may not realize or may not have the capital on hand immediately. So they are dipping into old, 401k accounts and moving it into some type of self-directed IRA vehicle. a lot of our audience is investing through their IRAs with their retirement capital. Um, and I notice even on your site, you're acknowledging that that is an option that you have. In your opinion and with your experience, why does real estate like this pair so well with retirement capital? And what should somebody know before they're using their funds that way?
I think that's a fantastic question. I think there's a lot of noise out there with all of these, trading and gambling sites that are, getting popular and get rich quick
Mhm.
schemes, and none of that works. If you want any significant growth or wealth, it's achieved over time by being consistent, by investing in high yield opportunities. And we like real estate because it's a higher yield opportunity outside of traditional public markets. And so it's a way to diversify outside of stocks and bonds that are, have, like we had talked about, that are subject to volatility outside of the investor's control and sometimes even the companies or the business's control.
Mhm.
So real estate being a good hedge against that, but also a good and a opportunity to see some of that compounding growth because real estate is also a long game. The people that make the most money from real estate are the ones that have been doing it or investing in real estate the longest.
Yeah, and I think a lot of the times when you have the naysayers or the people who are hesitant to use their retirement capital, they're always bringing up like, oh, it's even more risky. You have to know so many rules, and you have to be really, really careful. And to an extent, like they're right. You do have to be careful, but I feel like that shouldn't stop people when there are some really pretty simple rules to follow. And for listeners who may not be aware, it's really, I would say, three simple things. You have who you're allowed to invest with, and that's what's referred to as disqualified persons. You're not allowed to invest with anybody just directly up and down on the family tree with you. So that's who you're not allowed to invest with. There's the question of what you're allowed to invest in, what assets are allowable. And there's only three things that the IRS says you can't invest in: life insurance policies or contracts, collectibles, and S corporation stock. So this doesn't match that criteria, so it's available. And then lastly, as long as you're making decisions that are in the best interest of your self-directed IRA, then you're really in the clear. And there are other little rules to be aware of, but the bulk of people who are blowing up their IRA because they made some type of mistake or some type of prohibited transaction, it's one of those three things. So it's like you said, there's nothing that is, completely risk free, and self-directed IRAs do add some level of, additional compliance issues to keep in mind. But as far as, should that stop you from, you know, also utilizing your retirement capital to be able to get in an awesome deal or an awesome fund like this? I don't think it should. I think that's really interesting.
Yeah, absolutely.
Um, so I think this has been super insightful for listeners, and I want to be able to give them a place to go if they want to learn more, if they want to watch how your offerings develop. Where can they go? Where should they go? What's the best first step for somebody to take, who's curious but not ready to jump in quite yet?
Yeah, absolutely. I'd say, follow me on LinkedIn for sure. Always posting, financial education content, trying to teach first. I'm big on education. And then you can also join our newsletter at honeyshares.com, subscribe there. And then if anybody just wants to have a conversation, chat about their goals, I'm always open to that. You can do that through connecting with me on LinkedIn.
Well, this has been great, Keaton. Thank you so much. I think this is the kind of conversation that shows that there's a whole world of real estate really to be owned. Buy a rental yourself or just buy stock. For everyone listening, you can learn more about Keaton's platform at honeyshares.com, like he said. Go check him out on LinkedIn. Follow him. Look at how his offerings develop. Hit him up if you want to talk more. But as always, everything we talked about today is just strictly for educational purposes. We're all about just getting the information out there. We're not investment advisors. We're not promoting any specific investments. So as always, do your own due diligence. And yeah, really, really glad that we were able to have you on today. Thank you so much for your time, Keaton. And we'll see you next time.
Thanks, Nick. It was a pleasure.
Absolutely.
All right.